Okay. Welcome everyone for tonight's webinar about REIT Plus and a special session also with Simon from SGX, who is joining us tonight. My name is Sebastian. I'll be the host tonight, and I will mostly focus on trying to pick up all your questions in the Q&A tab and asking them to our panelists. Maybe we start with a very quick introduction. Just Dhruv and Simon, can you please quickly say hello to our audience?
Hi, Simon Karaban here from SGX. Yeah, and
Great. Dhruv, you want to quickly introduce yourself and then get right into it?
Sure. Hello, everyone, and thanks for tuning in tonight to our webinar with Simon from SGX. As you all know, we launched an enhanced REIT offering last week, and this would not have been possible without the assistance of SGX and specifically Simon and his team. So I'm sure you had a lot of questions, many of them which were probably asked to me, I think, in our webinar on Thursday, but today you can ask the man himself. The way how we plan to structure out today is I will, give a brief introduction on Syfe. We will then, pass it on to Simon to tell us a bit more about the index, a bit more of methodology. Then we'll open up for some questions. Then I can tell a bit more about Syfe, and then we'll again up for questions. So keep on, popping in those questions. Sebastian will, collate and pop them along. Some of you might know me. For those whom you don't, I'm the founder and CEO at Syfe. Let's get straight to it. What do you think, Sebastian? Shall we?
Yes, please.
Absolutely. All right. Welcome, everyone. Great. Yeah. So, as some of you know, Syfe is a CMS licensed digital wealth manager. We started with our wealth offering last year, which was actually very well received and shown quite brightly, especially in the last few months, given our focus on risk management. This portfolio is typically are the ones that are global, they are diversified across ETFs, and they focus, at a blend of equities, stocks, and, of course, gold. However, today's session is not about the global portfolio, though feel free to ask me questions later. Today, we are focusing on our offering, which we launched in the month of Feb, which is a Syfe REIT Plus. Now, some of you might remember when we launched REIT Plus in the month of Feb, we had launched an offering which was essentially risk managed. So it was REITs, but it had a composition of bonds with it. How these REITs were decided were based by our own methodology and our own team methodology. As we progressed, we realized, why don't we leave the selection of the REITs to the experts? And that is the reason why, in fact, today Simon is joining us from SGX. So as of now, essentially what ends up happening is our REIT index ends up tracking the S320, the IH S320, which Simon will talk about in detail. And as a user, you have two options. One is to track the index as it is, 100% into REITs. The other option is obviously where you allow us to change the composition of REITs and bonds, and we decrease the composition of REITs and add some bonds when the markets are volatile. Typically, this product has worked really well for users who are looking for some sort of extra passive income. And historically, the dividend has been in the 5% range. One thing to note, some of you might know, but I think worth highlighting here is that at Syfe, we also have an advisory team, which can actually help you with broader financial plannings and also better understanding of our offerings, right? But that's a very quick overview of Syfe. We will talk a bit more about it. On that count, I should maybe just stop my screen share and pass it on to you, Simon, and you can take lead from here.
Thanks very much, Dhruv. So I just want to echo some of your comments there, in the sense that we're very much proud to be working with you. I think you've developed an exciting new initiative here for investors to access the S-REIT market. And we're very much proud to be a part of this initiative with you. No further ado, I'd like to introduce the SGX S-REIT 20 Index. So I'll just share my screen with everyone. Just bear with me for a moment. Okay, I assume you can all see that okay? Yeah, okay.
Yes.
So I just wanted to give a bit of background information for the audience. SGX launched an index business known as SGX Index Edge almost 5 years ago now, actually, and it's obviously a relative newcomer to the indexing scene. However, we've definitely stamped our authority in terms of being able to develop indices across global markets beyond our own securities market here in Singapore in a more innovative and customized way for a lot of our clientele. The indices that are developed by SGX Index Edge are known as iEdge indices. So for those of you in the audience that might not be familiar with our branding approach for our own indices, even for the Singapore market, they're known as iEdge. You can obviously find more details on our website at sgx.com/indices. I'd like to get into the presentation with a bit of an overview on the Singapore REIT market. So a lot of this great research was put together by the equity research team at SGX, which provided some really insightful statistics that are very relevant for investors interested in investing in the REIT market. As you know, there are 45 trusts available and trading on SGX. One of the standout or key features of the S-REIT market relative to other well-developed REIT markets is the fact that it's effectively very well diversified. Yeah? So it's well diversified not just in terms of geography, but also well diversified in terms of the underlying assets that are held by the trusts. So over 80% of Singapore REITs and property trusts hold overseas assets. In addition to this, there's tremendous diversification in terms of the underlying assets or the properties that are held by these trusts, so across office REITs, shopping malls, hospitality REITs such as hotels, as well as even healthcare REITs, and even more recently, I believe, data center REITs. So there is great diversity both in terms of underlying asset as well as geography. And why is that important for investors? Well, it's important because it diversifies the risk for you. Any concentration in any one particular geography or any concentration in any one particular asset type will definitely increase the risk for investors. So diversity in REITs traded on SGX is obviously a very standout feature. There is also protection or some element of protection for investors. So S-REITs have a regulated gearing ratio to a limit of 45%. Which is quite a unique feature relative to REITs globally that can be very heavily leveraged. And obviously, especially during times of market distress, the high gearing ratios of some of the global REITs can pose problems for investors. So investors here are safeguarded to an extent with that gearing ratio limited to 45%. Yeah? One of the other attributes that I think is noteworthy to point out for Singapore in particular is that we have 26 trusts that have pan-Asia exposure. Yeah? If you look at the other markets, particularly the more well-established mature markets such as Japan, for example, which only has 8 trusts, similarly Hong Kong 2, it doesn't offer much exposure to what we could consider now very much a growth region in terms of Asia ex-Japan. So a lot of the more mature and established markets do not offer the growth story that perhaps Singapore can offer through more pan-Asia exposure. It's obviously a desirable attribute given that with an emerging middle class in Asia and great growth rates experienced across a lot of the economies in our region, we can obviously seize more opportunities through REITs. traded on SGX. In terms of the statistics at a glance, yield is obviously one of the main motivators to invest in REITs beyond the capital growth, of course. The average dividend yield across all REITs is 8.7%. This is not a weighted average, mind you. It's just a simple average of 8.7%. The annualized returns are definitely appealing, and later on we'll see how the SREIT 20 index that we have performs relative to the Straits Times index, for example. I'll go into the next slide that looks at the relative yield of SREITs. As I mentioned before, the average yield across all REITs is about 8.7%, far in excess of what you get in your bank account today. Obviously, in a very low yield environment, such as what we're experiencing now, with rates lower for longer, it's just going to increase the appeal of REITs as an investment proposition for a lot of investors. And it's easy to see here why, with 8.7% yield relative to a fixed deposit rate of 0.6%. Of course, investment decisions cannot be made on the basis of yield alone, and capital risks associated with that. With that, we go into some of the returns relative to other REIT markets. You can see that Singapore REITs have been indeed grown well relative to other REIT markets in the region. And a lot of the attributes that I shared before on the previous slide regarding diversification, as well as growth prospects and asset mix, have contributed to the SREIT market, demonstrating good growth relative to other markets in the region. I'll now go into a little bit more detail about the IEdge SREIT 20 index in terms of how it's constructed, what the composition of the index is, as well as what some of the performance attributes are for the index. So at a very broad level, we obviously look at the real estate investment trust listed on SGX, known as SREITs. And it's a selection criteria that really aims to look at the 20 largest and most tradable REITs in Singapore. So what we're looking for here is actually a very efficient replication of the entire SREIT market. So why is efficient replication important, and how is it achieved? Well, first of all, it's achieved through the fact that we look at size and liquidity. Yeah? So we're able to effectively get a better gauge in a more efficient way through a smaller selection of REITs that still allow you to get a good representation of all of the attributes of the REIT market in Singapore. Why is efficient representation like this important? Well, it makes the index a lot easier to track. So you can imagine that a smaller basket of REITs is much easier to manage for a portfolio manager or a digital wealth manager like Syfe, and compared to a very broad index in the marketplace. So what we're targeting here is efficient replication so that the portfolio can be managed in a more cost-effective way, and therefore with savings passed on to investors. Yeah? Once we are able to compile the largest and most liquid 20 REITs listed on SGX, then obviously have to think about how we're going to weight these individual REITs in a portfolio. So obviously the REITs that we have are weighted by free float market capitalization, or which is effectively a proxy for size. Yeah? We then also have an optimization feature to ensure that liquidity is enhanced in the portfolio. So all else being equal, those more liquid REITs, the ones that are more heavily traded and have higher trading volumes, will have a greater weight in the index. Again, serving its purpose to help portfolio managers manage a REIT index in the most cost-effective manner possible. Yeah? This index is not designed to achieve alpha. It's designed to be representative of the SREIT market in Singapore. It is exceptionally difficult to try and generate alpha on a market that is both relatively narrow and very, very transparent. There are very few opportunities to generate alpha through stock picking relative to an index that is designed in this way. When you design an index in this way, and where the size of the individual REITs contribute most to the index performance, and basically what we're doing is providing a measure to the market that on the aggregate reflects what the market wants. Yeah? So Ascendus REIT is not the largest REIT in the index by accident. It's the largest REIT in the index, and one of the largest certainly by free float market capitalization, because it is being rewarded by the market. Yeah? Its skill is being rewarded by the market, and that is effectively reflected in the index. Of course, the reverse is true for any of the smaller REITs that may not be well rewarded by the marketplace. So the index, in many respects, when it's weighted in this way by size, is getting a free ride on a lot of the good research that is digested by the marketplace and the view that is actually provided by the market on the aggregate. Hence why it's actually very difficult to overperform or generate alpha over and above such an index. The number of constituents is actually fixed at 20 at the current point in time. So if you do view the constituents, you'll see 20 of the largest and most liquid, as I mentioned before. Hence the name, the SREIT 20. In addition to this, the index has a semi-annual review process. So every March and September, we'll look at the statistics and the underlying REIT components of the index to ensure that each REIT within the index is still relevant in terms of its size and liquidity, and ensure that the index rules are properly applied on a periodic basis in March and September, also known as a semi-annual index rebalance, where there may be some turnover in terms of REITs being included or excluded during that semi-annual review process. Yeah. Now going to the next slide, having spoken a bit about the methodology, and talk about the performance attributes of the SREIT 20 index relative to the STI. So what we're looking at here is total return performance, which assumes that dividends are reinvested over time. Please don't be alarmed. The STI is not at a level of 1,000. What we did with this chart is that we rebased it so that you're able to see effectively how the SREIT 20 performs relative to the STI back in time over 10 years. Yeah? So what you can see is obviously the SREIT market as a component of the STI has performed exceptionally well. Obviously, there has been great demand from investors for SREITs, and this has been reflected in index performance relative to the general or the broader market being the STI. Yeah? There's obviously a number of factors that contribute to this outperformance. Obviously, a low rate environment and shifting to an even lower rate environment contributes to this type of growth and demand from market participants. But there are a number of variables at play to explain this relative performance. But in terms of relative performance, what you're seeing is significant outperformance relative to the STI of 1, 3, and 5 years at the same or lower level of risk measured by a measure of volatility through annualized standard deviation of returns relative to the Straits Times Index.
Simon, if may I just intervene and ask a good question from one of the viewers. They've just asked, like, when we build the index, right, like some of the key screeners are free float and velocity. Is there any plan to include dividend related metrics like DPUs or frequency of rights issues, presumption being that, lesser the rights issue, meaning like lesser diluted impact? Is that something which is in the plan to add as metrics?
No. Again, if we were to look at corporate actions retrospectively, it's always going to be retrospective.
Yeah.
Looking at retrospective corporate actions doesn't necessarily mean they're going to continue into the future. So we took a view on corporate actions. It may be misleading to investors. Similarly, on dividends, no. If we were to take a view on dividends and create, say, a yield-enhanced index, then we'd create an index that purposely tries to generate more yield. We wouldn't try and mix it into an index here, which is really designed to be an efficient representation of the S-REIT market in Singapore.
Got it. Great. Thank you.
I think one additional question, just because it's also about the corporate action, and the question we should definitely anticipate it, but what happens in the event of rights issues for the REIT portfolio, or to the index in this case?
Okay, so SGX has a comprehensive policy on how to treat corporate actions generally, which can be found on our website. But more specifically in terms of rights, so if you've got a heavily discounted offer, obviously on the X date, the price that you see is going to drop significantly for a REIT. That price drop in the REIT is not reflected as a drop in the index level, okay? The reason being is that we do what's called a divisor adjustment on the index to ensure that the index is a representation of market movement and not a representation of corporate actions that take place. Yeah? So we will assume that investors take up that offer if it's heavily discounted and reflect that in the index and make the necessary adjustments to ensure that the index level is not affected by heavily discounted offers like that.
Yeah, thank you.
Beyond the performance, I think the index breakdown is really just a further point to the diversification regarding geography, as well as the mix of assets that are available, which was obviously in the first slide, so I'll skip over this point. To go more into the constituents, and as I said before, what you're looking at here is the components as of 30 April, so it's very recent. We also make these components publicly available. So for anyone who's interested in seeing this, we do make it available to the marketplace, particularly if you have access to a variety of different data sources. We believe it's important to be transparent so that investors know exactly what they're buying into, but certainly Syfe is replicating the index portfolio, so you'll have a great deal of transparency in terms of what you're invested into every day. But here is a snapshot of the index, and obviously, as I mentioned before, the largest REITs obviously occupy the greatest percentage of the overall portfolio in the S-REIT 20. This means that the largest REITs are effectively going to drive the yield and performance a lot more than the smaller REITs in this portfolio. And as I mentioned before, Ascendas REIT is by far the largest and occupies the largest weight in this index indeed, because it's being rewarded by the marketplace. Yeah? The market on the aggregate has taken the view that Ascendas Real Estate Investment Trust deserves to have the largest weighting relative to other REITs in the overall market. Yeah? So it's an aggregate market view that leads to these relative size metrics. One point that we'd like to make about the index is that we cap the weights so that no one REIT at any one point in time at a rebalance state can go too far in excess of all the other REITs that are available in the marketplace. So for example, if Ascendas REIT, for whatever reason, did a huge capital raising and purchased a lot of assets globally, its weight could say get to 20% of the index, for example. Obviously, that will increase the concentration risks of the index and expose investors to that risk. So what we actually do is at each rebalance, as I mentioned before, in March and September, we apply 10% cap to ensure that no one REIT can occupy more than 10% of the index at the rebalance date. Obviously, between rebalance date, you have market movement and price fluctuation, which means that the weights do move a little bit beyond that 10% cap. The general methodology is presented here. I won't really go into it. It's a little bit dry in nature. You can certainly find out more about the methodology by going to our index web pages, as I mentioned before, at sgx.com/indices. We have a very detailed paper there that goes into the design of the index, how it's constructed and how it's managed on a day-to-day basis through the rules that are presented. Yes? Thank you very much all, and I'll leave my presentation there.
Great, thank you, Simon. I think it was very, very interesting. There are quite a number of questions which came up, and I think one I would just like to try to rephrase or repeat one of the answers you have given, because it came up a couple of times, which is about like making decisions in terms of which REITs are contained in the index. So one user is, for example, asking, how do you react to a threat of e-commerce? You know, that more people shop online, especially in this kind of situation. Retail REITs gonna be affected. If I remember correctly, you said that you are not taking a stand on those kind of metrics, and you basically let the market do an effective selection. There is so you use the market capitalization as well as the trading volume as key factors to choose, and they basically reflect what the market thinks about a certain REIT. Would that be an accurate summary?
It's a very accurate summary. So the index, at the end of the day, is a reflection of market sentiment on the REIT segment in Singapore. If the market, in the aggregate, of the view that retail REITs are going to suffer, that'll be directly reflected in the index. Yeah? So those REITs that do have heavy retail exposure, if the market on the aggregate views that retail REITs are going to suffer, then it will occupy a smaller portion of the index. Yeah? And it will be directly reflected within our index. So we're always a reflection of the aggregate view of the market.
Okay, and I think that would then also be the explanation why a REIT such as Eagle Hospitality would maybe not be included in this index. Thank you. Maybe a question to both of you, or maybe Dhruv. There's someone asking if an ETF issuer, and I know we're like Syfe is definitely not an ETF, but how do you make money, and do you benefit if an ETF is priced wrongly, or if your product is priced wrongly?
No, not really. In fact, there's a whole segment in the market which tries to, I mean, the ETF arbitrage traders who try to make money on those aspects. The ETF issuer's goal typically is to track a particular benchmark, and how they make money is on the basis of an ETF management fees, which is sometimes even called the total expense ratio, or TER in certain cases. So every time you buy an ETF, there will be a fees, a very small fees which you pay to the ETF issuer, which is, charged on a daily basis. It's extremely small. It's normally, in today's rate about just 0.1, 0.2% a year. And they basically make money from that. So they make money from management. They don't take market moves, or they don't, make any money from mispricing in the market.
And I think one thing I would like to add there is one advantage of buying or investing in a Syfe portfolio is that there is no brokerage or trading charges, because they are covered within Syfe's management fee. Another question for Simon. There's an example of Fraser Commercial Trust and Fraser Logistics and Industrial Trust merging, sorry, what's the date? Somewhere in between the rebalancing date of March and September. How would this be reflected if this does not happen basically in line with the two rebalancing dates?
So basically what we do at that point is we implement an index action, which again, there is scope for that within our index rules. So if there is a corporate activity such as a merger and acquisition or even a spin-off that does happen between rebalance dates, we reflect those changes immediately. If we find that there is one less component as a result of a merger, we'll find the next highest ranking and most liquid REIT for inclusion in the portfolio, so that we maintain that quota of 20 REITs. But certainly there is scope to change components within the index between rebalance dates to reflect the corporate activity. Yeah? So that was a good question.
Simon, just a follow-on question. If there is a merger in, let's say, two very significant and heavyweights within the index themselves, right? And where the combined weight, let's say, turns out to be like 15 or 20% for that reason, would that also mean that the 10% clause will start getting triggered and you will have to then decrease the weight in this case?
Not at that point, because if we do too many actions simultaneously beyond the simple corporate action, then that generates too much portfolio turnover.
Right.
And if too much portfolio turnover is generated, that can be costly for investors. So what we'll do is we'll wait until the next rebalance date to implement that 10% cap.
Got it. Thank you.
Thank you. There's actually, I want to combine two questions, and one user is asking like, why does the SGX work with Syfe? And someone else is actually asking, what's the difference between buying the IHS 320 via Syfe versus buying it directly on the stock market? I think an interesting question as well.
So yeah, why did we work with Syfe? I mean, we're obviously very excited about Syfe so that we can give investors the opportunity to further participate in the SREIT market. I also feel that really digital wealth management platforms are on the rise. I feel that technology is obviously a natural trend, not just in the space of consumer goods, but also in terms of financial technology and financial services. So increasingly, I find that investors are going to turn towards digital wealth management platforms, and we want to support that growth in any way that we can. Yeah? If investors want to access a portfolio or an index via Syfe, then we want to be able to support that. Yeah? So we also want to be able to demonstrate greater transparency in the market, and we do make our information freely available to ensure that investors know exactly what they're getting into, and to ensure that investors can get access to the SREIT market through a very well-governed index. Yeah? So can investors get access to the IHS REIT 20 by trading it directly on the exchange? No, you actually cannot do that at the moment. So there is no vehicle at the moment through which you can actually access this index.
Thank you. And this also answers one other question which asks about the management fees of the ETF. One more time about the index composition. A user is asking, what was the reason for deciding to have 20 constituents and not 15 or 30?
So that's a very good question. So we did a number of different tests and statistical studies to ensure that basically two bases covered. So the first one being obviously representation. How are we just effectively going to represent the S-REIT market in percentage terms. Yeah? The second component was, okay, given that liquidity can be a trade-off with too many REITs, how are we going to balance that out? So we did a statistical analysis which looked at the number of REITs in the portfolio versus how much liquidity can be compromised as we added another REIT. And we felt that 20 was the most optimal point at which, one, you're most representative of the REIT market, and two, ensuring that the portfolio is as liquid as possible. It is 20 at this point in time. Obviously, as the REIT market continues to grow in Singapore and as we get more REIT listings, we may need to revisit the number of REITs that we have. We may need to consider including more beyond the 20 quota that we have right now.
Thank you, Simon. Maybe one question for Dhruv in between. A user is asking, can I confirm that this product only tracks the IHS REIT 20 index and nothing else? Can you maybe share a little bit about the options a user has on Syfe?
Yeah, sure. I mean, let me just show a little slide, and I think that'll probably help. Give me 1 second. I'm just going to share my screen. Bear with me. Okay. So you can see that, Seb?
Yes, now we can see it. Yes.
Right. So essentially, like the REITs component, no matter which of the option you choose, will always track the IHN, SGREIT 20 index. Within Syfe, however, we have two options, which I was mentioning about earlier, and this is a bit more details. The one on the left is the 100% REIT option, which essentially is just tracking the index, verbatim, right? You can see some statistics and some highly traded REITs on your screen as I speak. The other option is actually the same concept which we use in our global portfolio, which is that of risk management, where we decrease the components of REITs in slightly volatile markets. Having said that, we still have a floor or a minimum of 50% on our REITs, right? So what happens is in volatile markets, we will decrease the REITs component down. And for example, right now, as markets are a bit volatile, we are currently at only 50% REITs, and the balance is actually Singapore government bonds, which we access through one of the locally listed ETFs, right? When markets calm down, this percentage actually can increase. And historically, there have been quite a few phases, but this percentage can actually be between 100 also. That's why you see it basically between 50 and 100% REITs, and the balance will be bonds, right? So it's almost like some level of, how do I say, I think one of the most attractive traits of REITs obviously is the dividend yield that they generate. Of course, the capital appreciation is also good. But the advantage of having bonds, which works for some users, is to have an aspect of capital preservation. So I think that's something which might be worthwhile.
Okay, thank you. One question about tax, which is, does the dividend attract income tax? I think one of the great benefits about REITs in Singapore. Who would like to elaborate on this a little bit?
I mean, I'm happy to elaborate because I'll have to face the customer. So I'll take this away from you. No, so there's actually, the real good thing is that there is no tax on the dividends. In fact, there is no tax if you're an individual. There is no tax even if you're a Singaporean corporate. So there is no taxation. You get the dividend as it is.
Great. I think one of the reasons why REITs are so popular in Singapore. Another question for you, Dhruv. A user is asking, following Simon's statement that as the REIT market grows, the 20 constituents may need to be revised. Will the REIT Plus portfolio adjust with this as well, or stick to 20?
No, it will adjust. So now, after our official partnership, which went live last week, we will track the index. So if this number goes up, we will increase proportionally as well, right? Our goal will be to track the index. I mean, we might, I don't know, have maybe one REIT, two REITs, less or more, but the goal would be to track the index to the highest level of accuracy, right? So if it goes from 20 to 30, it's quite likely we will go as well.
Okay, thank you. One of the questions, and would be interesting to have maybe both of your opinions on this, is always about market timing. And I know is a topic which is not one of our favorites, because for long-term investors like us, it's not the most critical. But what would you answer a user who is asking, is now a good time to get started, or is it better to wait for a bit?
Simon, I'll let you have the first go.
Okay. Okay, I think it ultimately depends on your circumstances, individual circumstances. As an investor, it depends on your goals as an investor. And certainly, I'm not a financial advisor, and I hesitate to comment on that point. But you know, it's obviously a very difficult time in the market. That is very, very evident. Things seem to have stabilized, at least from a volatility perspective. But from an investor point of view, you know, generally in terms of when you should start investing and when you should start accumulating your wealth, really, you know, the sooner the better is a general rule of thumb, if you can afford to do so. But again, I err on the side of caution and prefer not to go any deeper in my response without better understanding the individual circumstances.
Yeah. I mean, I think as advisors, we probably have to have a view, and we should. So in that matter, at least as Syfe is concerned. So, but I think what Simon said, I think, is something that I agree on as well. I think it's about, if you have the time, you know, definitely, you know, invest. And I say time, it means that if you are willing to hold it for a moderate to a long-term perspective, at least a few years and above, right? For you to wait and decide whether you will be able to get the bottom, I think it's a coin toss, because, you know, to be honest, I'm sure that a month ago, probably many people thought they can call the bottom as well. And we've actually, you know, had probably the best month in the markets in the month of April, in a decade for that matter, right? So I think it's very difficult to time the market. But what you do have is the time you have in the market, right? So if you are thinking of it as a moderate to long-term investment, I think it's always a good time, you know, to buy. I think one thing that I personally, and this is a bit of a personal view, right, is also that I think Singapore real estate market is very interesting, just because by and large there is limited supply, right, which is not really a concern for some of the very large, you know, landmass areas, etc. So I think that factor also starts playing in, at least when I look at it. But by and large, right, I think you know, if you're not really if you're somebody who can handle volatility, and there will be some volatility across the next couple of quarters, you know, I think this is a great time to get involved. But you know, it's a person-to-person thing, as Simon alluded to earlier.
Okay, two slightly similar questions, more related to Syfe, and therefore I want to direct this to Dhruv. Is if in the current situation, would you or what are the factors you would look at if a user wants to decide between a global portfolio, 100% REIT, or a risk managed REIT portfolio?
Sure. So when we build products at Syfe, right, I mean, everything essentially, the starting point is the user. We really try to achieve what the user is trying to do, right? So I think the purpose of the global portfolio is more to have a global level of diversification, having, you know, non-Singapore dollar exposure, because your investments are USD based, which I think is actually a great idea. And I think everyone should do it, because at the end of the day, our jobs are here, you know, our CPF is here, some of us have homes here, you know, so you have anyway a very heavy concentration towards Singapore and Singapore dollar, right? So I think some kind of diversification from that angle can really help. On the other hand, if you feel you're sufficiently diversified and looking for some more passive income, and you would like that to remain within the Singapore dollar scheme of things, I think that is where the REIT product, becomes interesting, right? Now, between the two product options, it comes down to what is your risk tolerance. And it's tough for me to answer this question without understanding how is your overall, financial setup. And that's why I strongly recommend, if possible, arrange a complimentary session with one of our advisors. They will be able to give you a broad gauge as to what is right for you. Because, for example, if you have invested a lot in very conservative assets, right? Let's say everything is in SSBs and fixed deposits, then a REIT 100 can be that element of riskiness in your product portfolio, right? Whereas if you're already very heavily invested in equities and you want something which is slightly less risky, then probably REITs with risk management is the right way to go, right? So I think without having full details, I think it's tough to quantify. But I hope that gives you some indicators. And as I said, feel free for a complimentary session with one of our advisors who will be able to guide what is the best product for you.
Okay, thank you. There's a couple of questions around what are the differences of the IH S320 versus some of the ETFs which are available in the market. Users mentioned Nico and Lion. Maybe, I don't know who wants to pick up this question.
Yeah, sure. I can pick it up. Dhruv, please chime in later on if you've got more to add. So there are a few REIT ETF solutions in the market. So one of the indices that we did for investors was actually an Asia Pacific ex-Japan REIT, which includes REITs beyond Singapore. It includes Australian REITs as well as Hong Kong REITs and any others in the region that are eligible beyond, excluding Japan, of course. So that portfolio is heavily weighted towards Australian REITs, Singapore REITs, and I think there's one Hong Kong REIT and there's Link REIT included in that portfolio. So that's currently available on SGX. You're not just getting the S REITs, you're getting obviously the REITs from the other markets there as well. And of course, you'll only be exposed to the risk of the REITs. You'll also be exposed to the foreign exchange risk that you get with underlying investments denominated in, say, Aussie dollar and Hong Kong dollar in that portfolio. But you do get added diversification, of course. That index also is not market capitalization weighted, it's actually dividend weighted. So we went for a different strategy with that index for capital. As it relates to the Nikko ETF, that is also an Asia ex-Japan portfolio. So it goes beyond Singapore REITs. It is therefore covering many more REITs beyond the 20 in IHS REIT 20. It is different to the Asia Pacific REIT that is issued by Phillip Capital because one is not dividend weighted, and number two, it excludes Australia. It's purely Asia ex-Japan. Yeah. The other ETF, which is more focused on the Singapore REIT market, is issued by Lion Phillip, and that's actually referencing a Morningstar index, which is trying to outperform the market through a few different types of metrics that they've incorporated into their index methodology. It is our understanding that the benchmark, being the S-REIT index issued by IH, is outperforming that index on a consistent basis over time. And there are various complex attributes to that underlying Morningstar index that goes beyond a very simple and effective methodology that we have on the S-REIT market.
I think I have nothing to add. I think you've covered the points really well, right? I also think that I think maybe for the users, I think those ETFs are, a set of indices or set of benchmarks they follow, whereas the iEdge is just a different benchmark altogether, right? So I think that's one thing worth tracking on. Yeah. Seb, should I do some more of a quick go through some of the slides which we have, or do you think we have a...
Yes, I think that would be great because there is a lot of questions about Syfe itself, which I have so far ignored in anticipation of you showing a couple of slides on this.
Great, yeah. So let me just get on with it, right? And the good thing is we don't have many slides. I don't think I'll need more than about 5 or 10 minutes maximum for this, and then we can get back to the Q&A for both myself and Simon. So yeah, so just to bring everyone back onto the screen, we were at the point where we're talking of the two options. You can toggle between these options, at any point with no extra cost within your existing price as well. Of course, we don't recommend changing things too often because otherwise, you have to have a plan and stick to it for some time to see it through, right? If you're going to be tracking it with every day and every move, then, it becomes a bit like, coin tossing, which is not really recommended too much in the markets. Great, yeah. So one interesting benchmark we got asked was like, should I take, a benchmark which is on risk management, or should I just go for a pure index, right? Now, the fact is that if there are going to be sustained periods of market, rise, you will see that a pure index benchmark or a REIT 100 offering will actually end up, outperforming, right? If you see that in the early part of Feb, right? However, if drastic moves happen, like what happened, in the month of March, they're essentially, having a component of bonds in your portfolio can really alleviate the pain. I mean, it helps both on a lower correction, but it also helps on the fact that sometimes bonds actually end up rallying or rather increasing in value. So it becomes not just a nullifying effect, but also a positive opposite effect, right? So somebody asked like so technically, if you see the golden line is the risk management option, and the blue line is 100% REITs, right? So again, if you see that, the gap was, quite large, and, it has corrected a bit as markets keep on rallying. So depending, whether if you have the appetite and, seeing your broader portfolio, you might find more value in 100% REITs option. But for those, who don't have the appetite of absorbing risk or having severe downsides, right? Essentially, they might find value in a setup which is, risk managed as this particular case was, which is the REITs with risk management, which is the golden line out here, right? And on the, the blue points actually, sorry, the red points tell you the points when we actually rebalanced. And some of you, have been customers from early Feb. You would have experienced this, firsthand. And it was quite interesting because I think after we did it, a couple of clients actually, oh my God, you're buying low, you're selling high, and all that stuff. But the fact is that all those, really doesn't matter, because what might look like a high price to buy or a low price to sell might make sense in a span of 1 day or 1 week, but over time, the points where we rebalance, actually the markets even head up lower. So because of the virtue of customers kind of, cushioned, and this process happens automatically, we scan every portfolio every day. If you choose the risk management option, and we adjust the constitution of the REITs and bond component. So then you don't really have to do it. So I guess the point is these red dots were automatically done and the customers were informed. It wasn't something that users had to choose and they had manually have to change. So one, question, of course, is that, why should I come for a REIT plus, and why should I, rather than doing DIY? I think the first point, and I think we haven't probably mentioned because this whole presentation is about, is that at the end of the day, as Simon mentioned, we are essentially tracking the REIT index ourselves, right? Which is essentially, 20 constituents in a very, particular set of composition to assure you, the high quality of returns and dividends, but still, enough diversification. If you were to do it yourself, I think to replicate would be extremely cumbersome, because you'll have to go and buy 20 underlyings and then 100 units per underlying and then multiples of that. So to get that exact composition will be very, very expensive, right? And time consuming. And the other point is also when you are with, a REIT plus setup, you don't really have to have a CDP or brokerage account. It's essentially like an end-to-end, a setup. So you come in, you park your funds, and we'll take care of everything else. The time required is literally in minutes. I mean, if you start working now, before I finish my slides, you'll be able to, sign up as well, right? And additionally, some really unique features is that we do have an optional risk management if you choose that to have. We obviously automatically will rebalance and reoptimize as per the index constitutions, as Simon and the team deem right at every rebalance. And this is very interesting, right? Now we will actually automatically reinvest your dividends. Now the aspect is that a lot of people who get paid dividends, they don't end up reinvesting, because the fact is, even if you get a dividend, let's say of $100, right, it's a decent sized dividend, right? For you to reinvest it, you'll have to pay $10, $20 away to your broker, right? So you've lost about 10% of it as it is, whereas in Syfe, it's already included in your price. And if you can reinvest your dividends over time, as we've been seeing, and we have run some numbers, you approximately, at least on the SGX REIT index, you approximately can get an upside of almost about 50 basis points a year by just reinvesting your dividends, right? And this is great because just by having this functionality, you've kind of paid for your, setup already. Bear in mind, you can withdraw anytime from Syfe, and you can also choose an option for customers who are in our black and gold tier, and I'll come to black and gold in a moment. You can also choose to have these dividends getting paid out to you in your bank account on a quarterly basis, should you, require. But again, as I said, this is something you should do if you need the cash. If you don't need the cash, let it stay invested. And again, you can withdraw anytime. There is no withdrawal charges. It's a very quick process, and that's the right thing to do. Lastly, there's no brokerage fees. It's already included. If you have to do it yourself, you'll have to pay a brokerage fee, which can be quite significant, especially the minimums you have to pay per line. There are some kind of managed fund solutions which claim to offer similar setups, but typically their fees is much higher than where Syfe is, right? So the management fee at Syfe, and I'll come to that in a moment, is between 0.4 and 0.65%. So how do you really get started? It's actually quite simple. You can just go to syfe.com, and on the right hand side, you can click the get started button. You can even do it from our app. Once you do it, there's a very quick risk analyzer. We show you the REIT portfolio. You can choose whether you want risk management or you don't want risk management. And after that, there is a very quick onboarding through MyInfo. And that's it. You're done. I mean, everything is set up. You transfer the funds, and then on the right hand side, you can actually see it both on the mobile as well as web platform, right? So the entire process actually is very, very special. And this, the platform that we've built, right, is actually quite unique, because not only do you see these graphs, but actually if you scroll down on the app, you can see your exact constituents, how much dividend, you have received, what is the dividend cycle, what is your current, composition, what is the different components. So all, relevant information is already there, right? And we're obviously constantly improving this thing, but it's really great. If you ever need to withdraw funds, you can just hit on that little minus sign on top. You can fill in the details, and we will withdraw whether you want a partial withdrawal or a full withdrawal, as the case might be, right? So basically everything that you need is right with you, on that panel and at your control, right? One question that gets asked to us is about security and safety, and I think this might be important to realize that we are licensed by the MAS for fund management. So we are CMS licensed. And in fact, we are CMS licensed for retail, which makes us in a very unique situation where we can take clients irrespective of their size, right? Whether you have, a few $100s or you have few hundreds of thousands of dollars, we have all kind of customers on our platform, right? What is also important and very, very important to know is that when you transfer funds to Syfe, you're not really transferring funds to Syfe. You are transferring it to a segregated client account, which is actually maintained at DVS. And this is called what's also called like a trust account. So what's interesting is that this is completely separate from Syfe own finances and its own funding. In fact, we use a different bank for our day-to-day, expenses and operations. And this is purely client's account, and we can't use it for any of our functions, right? After that point, from DBS, we move these funds across through our broker Saxo, which then further, if you're investing in the global portfolio, it ends up getting custodized with Citibank. If you're investing in our Singapore portfolio, it actually ends up getting custodized with HSBC. So as you can see, the security aspect is very, very important to us. And just getting this license, I mean, to be honest, though we started our first product offering in July last year, we were trying to work on this for almost 2 years, because to get the license, it almost took us a year, because the MAS is it's a great regulator, and they have very high standards of safety and security of end customers like yourselves. So we needed to have internal compliance, external compliance, internal auditor. A Big Four is our external auditor. So there are a lot of bells and whistles and checks in place to ensure smooth functioning and safety of your assets at all points in time. And then, yeah, of course, as you mentioned about pricing, right? We have an
Dhruv, sorry to interrupt, but I think there were a couple of questions. And I think it fits very well to the previous slide. I think you have explained in a lot of detail how capital is protected, like the client funds are handled safely. What would happen in a worst case scenario? We have 2 or 3 people asking. Can you maybe quickly elaborate on this?
Sure, yeah. I mean, this is obviously a question, no fund manager would like to answer, but I think it's important that I answer this question so, you have that security of what happens in this case, right? So the way how a CMS license is structured is that to even get the license, you have to have a significant base capital and something which is called a PII, a professional indemnity insurance, right? The purpose of these is to also ensure in case there is ever a setup where a fund manager has to wind down, there is a proper exit process in place, right? So what happens is that typically 2 of the parts are taken place in case of an exit route, right? Option 1 is where MAS will grant the funds to another fund manager, where you as customers will have the choice to either continue using, that fund manager or withdraw, your funds out. Option 2 is that you will have the right and permission to withdraw the funds and take them away. As I mentioned, because all these funds are already maintained in a trust account and then further in custody, which we really can't access for our own purposes, whenever such a step has to happen, it's not going to be like, tomorrow we are closing down, everything is over. No, it's not about that. This process actually happens over weeks and months, right? As you might have seen in some of the other cases, right? So it's a very, there's a very procedural action out there, but the 2 parts are either, it gets taken over by another fund manager, or essentially you will have, the right to unwind and you can then take your funds out. And again, because they are clients' funds, they will end up going to the clients who are the rightful owners of these funds.
Thank you, Dhruv.
Okay, in that case, I will carry on. So yeah, just the last couple of slides then. So our pricing, as I mentioned, is all inclusive. We don't want to have, trading fees and, entry charges and minimum balance charges and all that stuff. No, when we started Syfe, right, in many angles, we wanted to get away some of the things that have, I guess, plagued the wealth management industry, where there is lack of transparency and, there's this 1 layer charge, 2nd layer charge, 4th layer charge, and so on and so forth. So what you pay is very transparent. You see it here. We have I think we're the few people where on your portfolio level, you will see what fees you've paid upfront, right? Otherwise, you could normally hide or wait for a month-end report to see what that fees is, because you should know what you're paying. But what we do in this phase is, as I said, we manage all the charges, which is, responsible for you. And at the same time, this also, ends up, covering for our charges, whether it's conducting seminars, webinars, paying salaries for people, as the case might be, right? So it's a very, very, transparent setup, because we believe we want to build the whole setup on transparency. And even if you see, when you sign up, right, on Syfe, you end up seeing what you're investing in before you invest, right? Whereas in many other providers, I think it's a bit of a black box. You invest and then we'll tell you what our secret sauce is, right? Great, yeah, which gets me to what exactly are our fees plans. So we basically have 4 tiers. As you can see, the fees comes down as you increase in value. Now, bear in mind, this is a function of your overall invested assets. This could be across multiple REITs portfolio or multiple global portfolios, as the case might be. The fee starts at 65 basis points or 0.65% and goes down to 0.4% for our gold customers. Gold customers are those who have invested a cumulative sum of north of $100,000, right? Additionally, if you're on a black or gold service, you have access to financial advisors. You do get them complimentary in your first month if you're on blue. And there's an optional financial planning session which is charged for the blue customers should they need it. You don't have to. But for the black and gold, it is actually included in their plan. Now, we've actually had quite a few customers in recent times who've actually had a very significant sizes, who've actually invested north of $500,000. Typically here, we realize that they need other aspects or other concerns to be addressed to. So if that is what you're looking for, please, drop us an email, go to our advisory channel, or, there's a platinum option on our website that you can choose. And one of our, regarded advisors will reach back to you, understand your case a bit better, and come back to you with next steps, right? This entire fees, last to mention, is on a per annum basis. So let's say you come and you decide after a week this is not right for you, you will only pay for the duration of that fee. So which is great, right? So there's no like entry, exit, or kind of lockups, right? Which is one of the big reasons that a lot of people don't invest, because they are scared, like, oh, what if I need the money? Will there be charges and so on and so forth? No, nothing of that sort, right? So it's your money and you should have it at all points in time. And lastly, right, I mean, we do have quite a big team, but I think some of the key people, I think, which are worth highlighting in our investment team. Myself, most of my career was with UBS. As you can see, portfolio trading and, ETFs are very close to my heart, because that's what I did, a bread and butter for a very, very long period of time. Then after that, I had a chance to, build a very successful consumer tech company. And somewhere while building Syfe, these two principles are coming together. On the investment side, also, we have Richard, who's been an incredible asset to Syfe from day one. His pedigree is so large that I think, even a slide won't be enough. But I think more recently, he was a professor of, risk management and portfolio construction at NUS, and formerly has held some very, senior posts, such as being a senior director at Lion Global, as well as a CEO of UOB Venture Management. Akiko, is a PhD, FRM, one of the smartest people I've worked with. Was a fund manager formerly at Tokyo Marine, and holds a PhD in astronomy. And it's a good question to ask her someday how those and numbers make sense. After working with her for a couple of years, I can tell you they two aligned really, really well. And lastly, of course, we have Ritesh, right, who joined us from Goldman Sachs last year, who brings in great expertise, both in risk management, which he had when he was a vice president at Morgan Stanley, but also understanding about users and understanding how we can give high quality wealth management service to our users like yourself tuned in tonight. Great. So if, we'll of course be here to answer all questions, but of course, as I mentioned a couple of times earlier, feel free to talk to one of our experts. These are, qualified licensed experts who come with pedigree, like, people like Melvin who worked at DBS, or people like Ritesh who have, formerly worked at Goldman Sachs. So the pedigree of, expertise you will get will be top notch. And because we have no entry and exit fees, none of us are really salesy. We are building this for the long term, where we hope you will like what we built for years and decades to come, right? And I hope you can find this out here at Syfe. Great. And thanks for tuning in today. We will be here for answering questions, but there's a little promo code should you choose to invest today. All you need to do is fill up a short survey and mention the promo code when you sign up, and you can receive up to $100 in bonus. With that, one last thing. We have a bit more of a detailed deep dive into our investment strategy, which happens next week on the 14th of May. Should you like to join, a bit more about how we manage risk, which includes both RE and our, the REIT with risk management, as well as our global offering. But we keep on doing them on a weekly basis, so please tune in if that's relevant. And with that, please fill the survey, and I will pass it back for further Q&A for Simon and myself. How are we doing on time, Simon? You've got some time for us today, or how are we looking on time right now?
Yeah, I've got another 15 minutes. Yeah.
Okay, great. So Seb, why don't you focus a bit more on questions for Simon, and then I can chime in where relevant. You're still on mute, Simon. Seb, you're still on mute.
Yes, sorry. Yes, there's one who again who missed the difference between the Morningstar and the iEdge S320 index. Maybe just in one sentence you can summarize this one more time, as I'm unfortunately not able to answer that.
Sure. Yeah. So the iEdge S320 aims to be representative of the S-REIT market in Singapore. It is purely based on metrics related to size and liquidity. And the goal there is to be representative in a very efficient and cost-effective way. For the Morningstar Index, the selection criteria is not purely based on market cap and liquidity metrics. The goals for that index are not to be a direct representation of the market. They have different selection criteria. They have a different number of REITs in their index as well. So they are not alike. And as a result, the performance is unlike the performance of the iEdge S320.
Okay, thank you. I think that clarifies. Dhruv, may I ask you to put again up the slide with the QR code? There is a user asking how he can get the sign-up bonus, and the answer is to scan the QR code and answer the very short feedback form which you have, and at the end there will be the bonus, the code which helps you to get the bonus. One additional question for Dhruv. A couple of people are asking about the regular savings plan. How can I, or what does it cost me, and how can I basically contribute monthly to my portfolio?
Yeah, it's a great question, right? In fact, I would say almost 4 out of 5 customers on our side, they contribute on a monthly basis. The beauty of our RSP plan is that you can turn it off on anytime you want, right? Of course, as an advisor, the recommendation is to stick to it, but you're not really bound to stick to it at all points. There's no penalty or fees. At the same time, you can increase or decrease if you've had good months and bad months and high expenses and low expenses, right? So the best way to do it is to actually set up regular payment on your banking side. And when you sign up, if you can actually, you can see this reference code or your portfolio code. All you need to do is transfer funds to the the Syfe client's account, which as when you sign up you can see, and set the amount, set a frequency as it's suitable to you, and in the reference code just mention the portfolio code. As long as the portfolio code on a monthly basis, it will get credited to us, and it will reflect within your portfolio within 1 to 2 days, right? And as I said, 4 out of 5 users do it, and it's quite easy. If you have further questions, or if you're not sure how to do it at your bank, drop us an email at support@Syfe, and we can share a guide on a per bank basis also, if that's helpful.
Okay, great. And then there is a couple of questions which are around the risk managed portfolio. One question is about the different returns. And so someone asked bluntly, why would I go with the 100% REIT portfolio if the risk managed gives me almost the same return? And someone else is asking, what would be a good share of bonds for a retiree?
So I think slightly different questions on both of them. Let me answer the first one before, right? So I think, yes, I mean, if you look in recent times, I think risk management has given slightly, similar, but still slightly lower returns compared to REITs, right? As I said, I mean, the advantage of going for 100% REITs is if you want complete exposure to the sector, right? The advantage of doing that becomes that, let's take, for example, there's been some price correction right now, and as we all hope the markets will recover and things will get back to normal, then you will expect, there to be a much higher recovery. So if I look back at data, there have been times where, the REIT index of 100% REITs has done, well, and actually has gained much more than, the bonds index. So the point is that if you are willing to lose a little bit of upside, but have that security in mind that you will kind of protect your downside, I think risk management is the right option for you. But if your goal is just to maximize your REITs and dividends and focus that, because again, it could be a part of your broader portfolio, which without knowing, I really can't, answer. Then, but the 100% REITs might be a good option for you. So I hope that answers that question, right? The next question you asked was about for a retiree, what's the composition? Again, typically we believe that people who are retired, they generally have a lower risk appetite. So I would say you should just go for the REITs with the risk management. You really can't choose the percentage of bonds in that. I mean, we just tweak the percentage of bonds depending on your portfolio volatility. So it's a great option for you. I think for you, given, typically when you're a retiree, your risk appetite is lower, which means, coming back to the point, what that would mean is that we will keep the REITs component between 50% and 100%. And which that means the bonds composition will be between 50% and 0%, right? So essentially we will, the REITs will increase or decrease to reflect market volatility. They will never go below 50, and obviously they will never go over 100, but that means that your bonds can be zero also. So we don't allow you a function to actually choose the bonds itself. If you do have a preference to choose yourself, then probably you can choose the REITs 100 option, but then buy the bonds on the platform, because we don't allow you to cherry pick and these constituents, if that is something that you might want to do.
Great. Thank you. I think the last question, which is addressed to Simon, which is at least currently there, is the following, and maybe you can help me to confirm I understand correctly. A user is asking about the annual returns, TR, or like total return of 27.1%. Versus the dividend yield of 5.1%. Am I correct that if it's the total return, it already includes the dividend yield?
Yes, that's right. Yeah. So total return implies, or actually, just implies it's actually incorporates all of the income reinvested in the index.
Yeah. So I think it's great, and this is I think what we're also trying to do with our portfolio, because every the dividend basically immediately starts earning extra dividends and extra returns again. Thank you. Maybe one other question, which is for both of you, is Syfe planning to come up with a risk match portfolio for emerging economies as well? And maybe like for Simon, is there an index which tracks emerging economies by IH?
In regards to the index, we have several indices that focus on different types of themes. Some cover Asia, ex-Japan more broadly, which obviously has a strong emerging market component. In regards to something specific for emerging economies, that gives simple exposure, no, we do not. However, we can build it. Yeah. So with a lot of the data and research at our disposal, we do offer solutions not across developed markets as underpinnings, but also emerging economies. One of the things that we've been working on more recently with an asset management client is actually a China new economy concept. So obviously China is shifting from an industrial economy, where its strength was built on manufacturing, and shifting towards more of a services-based economy driven by the rise of the consumer, and obviously developing an economy that's deeper in intellectual property now. So we're building an index to reflect China new economy. We're going to be profiling that fairly soon. But certainly, as I said before, our strength is in being able to customize solutions through a base of innovation, which results from a lot of the data and research that we have at our disposal.
Thank you, Simon. I think similar for Syfe, Dhruv, I think there's currently no plan to create a portfolio which is focused on the emerging markets, correct?
Yeah, I mean, our goal is that we will end up looking at our global portfolio, a setup which gives the best returns for the level of risk that users choose, right? Currently and even in the past, that risk-reward ratio has been favoring a more, a focus which is blended with developed world and emerging world as into one. There's no pure emerging play in the pipeline at the moment.
Great. Simon, a user is asking, or a viewer is asking, you compared on one of your slides the S-REIT 20 index with the STI. And now he's asking, like, does the S-REIT index follow closely the STI, or and is there basically a strong correlation between the two, if I understand the question correctly?
Yeah, look, I mean, there is obviously equity market risk in REITs, and therefore there will be equity market risk reflected in the S-REIT 20 index, or in any S-REIT portfolio for that matter. There will be a degree of correlation. I do not have the exact correlation statistics, however, on hand. Generally speaking, However, REITs are seen as a good diversifier relative to the broader equity market. As you're probably aware, REITs have basically fixed income attributes, right? So they have attributes similar to bonds, given that they pay out a very high percentage of the passive income, or they pay out all of the passive income of their underlying assets. So so a lot of the mechanisms behind the REITs, attributes of REITs are quite fixed income like in nature, which means that they're actually a good complement to an equity portfolio, and can offer a good diversification when combined with an equity portfolio. So I guess short answer to that question, yes, correlated to a degree because of the equity market risk, but it also has good diversification benefits since it has fixed income attributes.
Okay, thank you very much. A couple of questions for Dhruv. One is about dividends and payouts. Are there any fees related to this, and who is eligible for an automatic dividend payout?
Yeah,
and
so
how often does it also happen?
Yeah. So we credit your portfolio. Everyone gets, their proportional share of dividend as soon as it is paid out. So everyone gets their dividend. Everyone's eligible for it, right? When I said paid out for black and gold customers, what I meant was typically, as I mentioned, everyone gets paid out and we reinvest. But if you're on the black or gold program, in your case, we can actually pull out those dividends and credit your bank account. So pull it out from your account and credit to your bank account on a quarterly basis. The reason why we do this for some of our higher value customers, they like it some sort of passive income which comes to their bank account on a regular basis. So if you're on our black or gold program, we can actually, credit to your bank account from your account itself. So there is no financial difference whether you're a blue, black, or a gold customer. It's the same in all, right? But if you're on a black or gold program, i.e. if you have invested north of $20,000, then you can choose to have these credited to your bank account on a quarterly basis.
Okay, thank you. What are the key differentiators and how is Syfe different to some of its competitors?
Yeah, I mean, I guess the fact that myself and Simon are here, I mean, that should be a differentiator. No, I think, there are multiple fronts here. I think firstly, I think we're the only ones that are offering anything on the REITs front. I think it's a very unique offering. But I think broadly, I think a couple of the differences are around the fact that we generally focus on risk management, whether in the REITs or the global offering, right? And this has actually performed really well in the recent markets in turmoil. I think a lot of customers were very secure investing with us, and that's why we hardly had any withdrawals. And in fact, every day we've had net positive inflows, right? So which is, a big, a stamp of approval that our risk management actually works, right, in what we do. And I think the third aspect, I think, is also about advisory, as we have a very qualified and legitimate advisory team, which helps users make, correct decisions, right? So as I said, our goal is to build a long-term relationship, and whether it's our products or whether it's an advisory service or whether it's our approach, I think all of them reflect the same. And I think it's a very big differentiator versus some of the other, players out there.
Thank you. There is a question which I'm personally also interested in to Simon. Are there currently any other partnerships with other digital wealth managers in the works?
No, not at the moment. Obviously, we see strong growth in this segment, not just in Singapore, but across other fintech hubs. And we'll look to engage with other partners across a variety of different solutions. But certainly, Syfe, was quite enterprising in the way in which they approached us and SGX to kick off this partnership. And I think there's some natural reciprocal benefits in working together.
Great, thank you. Dhruv, you mentioned earlier that it's very easy to switch between the 100% REIT portfolio and the risk managed portfolio. One viewer is asking, what strategy would you suggest for this current year and situation, or maybe overall?
Yeah, I mean, as I said, right, I think this is same as some of the early user asked. I think without knowing your full, perception, it's tough to say, right? But if you are generally risk averse, or if you have other riskier assets, then I think having a managed portfolio probably is, or a risk managed portfolio is the right option. If on the other hand, you're looking this as an exposure to the REIT sector, and this is one of the, you're willing to take the volatility along with it, then I would suggest, the 100% REITs. As I said, they both cater to different user needs, right? And if you're not sure which is your user need, I would strongly recommend, again, speak to one of our advisors, because, you might not be able to share some personal details on a public forum, and understandably so. But, you can have an in-confidence meeting with them, and they'll be able to guide you through, and which I would say a lot of users have benefited from. So I would strongly recommend that, yeah.
And related to this, Fiona, as well as a couple of other viewers are asking, like, do you recommend a lump sum and monthly deposits, or a smaller lump sum and higher monthly deposits, or just monthly deposits?
Oh, that's a very, very good question. And in fact, we said this last time, Seb, but we forgot to add that slide on. We should probably add it on the next time, right? But we actually ran some statistics on this. So in a quantified way, tried to come up with this answer, because both, intuitively have their pros and cons. What we realized was that on a 24-month rolling period, on every 2-year period, if you had seen, lump sum had outperformed monthly deposits in 75% of cases. So if you have the money and if you have no need, then lump sum is a better option, right? So I would obviously skew it more towards a lump sum. Having said that, everyone might not have it. So if you're a salaried employee and you're saving, let's say, a few $1,000s a month, then essentially do, the monthly setup. So I think obviously see your broader situation, but if you have the funds and you are just deciding when to park in, then lump sum actually 75% of time has outperformed, the DCA or the monthly kind of top-ups which you do. But again, if you can't do that, or if you need the money or you don't have the resources, then obviously carry on with the DCA approach. I think, so how do I put it, right? It's better to do lump sum over, a DCA. But I mean, it's better to do DCA than not invest at all, right? So keep that in mind as you might go.
Thank you. Simon, I think you have to drop off.
Yes.
Thank you very much for the answers. I think also all the viewers really appreciate your expert, to have the expert on this webinar himself. Again, thanks a lot. We hope to welcome you on another webinar sometime soon. But yeah, for the time being, enjoy your evening, and thanks for staying with us so late.
Simon, one question before you go from me, which I think a user also asked. They asked, do you have a Syfe account? Do you plan to get one soon? Thank you. That was
I don't have a Syfe account. I should definitely look into it. Maybe you could give me some preferential rates there.
Yeah, there's just scan the QR code on your screen now and get a promo discount. Yeah, so
give me a discount. Yeah. Look, it was my pleasure to be a part of this. It was my pleasure to speak with the audience and to answer the questions. And thank you, Sebastian and Dhruv, for inviting me.
Thank you so much, Simon. Thank you so much.
Take care.
Thank you. Goodbye.
Bye.
Seb, do we stick around for some more time answering some more questions?
Yes, I think we have I think 10, 15 questions left. Let's try to get through them in the next like 10 minutes or so. What about CPF and SRS funds? I have tried to answer these questions directly in the Q&A, but it keeps coming up. Can you share
Yeah,
Or
so CPF not currently. I mean, it's a bit of a long drawn process. It will take us some time before that gets active. SRS we're actually working on already. It's in advanced stages, but it's just been taking longer given the broader situation. So I hope in the next few months, we have it. But again, I mean, this is something which is a bit more of an external factor, but it's high on our priority, and we are working on it to ensure that this can be done. Yeah.
is it possible to move the REITs into your own CDP account?
No, not currently. In fact, the whole advantage of doing this setup and the reason why we can do it so efficiently and fractional share ownership at low cost is because we are managing it. So you can't move it. You can't move from it to your CDP or from your CDP to Syfe for that matter. Yeah.
Yeah, I think that's a really important point. The cost structure simply would not allow that, and I think we have shared who is the custodian of the REITs, and it's a very large financial institution, so I think very safe. There's a user asking, Syfe's value add to customer is through the RE algorithm. Why would a user opt for the 100% portfolio? We have already partly answered this, but maybe you can quickly, in a few sentences, elaborate on this again.
Yeah, to be honest, that's a great question. I think when we started, we only started with the risk management piece. But what we realized, and this again came, and that's why we are a very pro user company, right? A lot of users came back and they said for them, they look at REITs as a different asset class, a part of their investment portfolio. They want to stay invested through downturns and ups, and they don't want us to change the risk allocation as the case might be, right? So keeping that in mind, certain users, and I think it makes sense also. I have portfolios which are also 100% REITs because it's a part of my broader asset allocation, right? So keeping that in mind, depending on the user, this is the right option, right? And essentially what we have done is we've streamlined the process where we can turn it on and off as the case might be.
Great. There is a user asking, is the stock price locked at the moment I pay now Syfe?
No, it's not really. We actually transact because you move the money needs to be verified. If it's a significant amount, then regular AML KYC checks needs to be done. And after that, we trade. We end up trading essentially. If you move the funds before 11 a.m., we end up trading that same afternoon. If you move it after 11 a.m., we trade it the next day. So we trade sometime, usually in the afternoon. But depending whether you move before 11 a.m. or after 11 a.m. and assuming your KYC, ML, etc. is all cleans out, it gets traded that day or the next day.
Great. There is someone asking about our tech platform which we're using. Is it built in-house or do you work, is it based on a third party?
No, in fact, a big part of our team, I would say almost close to 40 to 45% is actually engineering and product. Everything that we've built is completely in-house. That's why we were able to offer this product also so quickly. We launched a variation literally 3 months after we launched the original, REIT Plus offering. So it's 100% in-house, it's 100% proprietary. And that's why we can do some really unique and one-off features like reinvesting small amounts or automatic reinvesting or payout as the case might be.
Okay, fantastic. I think there's a very interesting question. What are some of the topics we should discuss with the financial expert during the scheduled phone call?
Sure. So you could actually talk about multiple things. Talk about football if you like as well. But typically what people end up asking is about, they try to understand where they are in life. I think the first question many of them try to ask is, should they invest or should they save? What should they do, right? And if they invest, what is the right way for them to invest? Many times they tell about their existing investments and we end up telling how Syfe can essentially complement it, right? Sometimes it also happens that we realize that the user's risk profile or because what they're looking for is not something that we can offer, we'll tell them we are even not right for you. But essentially, I think if you want a better understanding of your own finances through an expert, or a better understanding of our products and how they can sit with your financial goals and your aspirations, I think those are some of the topics you can speak, with the financial advisor.
Great, thank you. There's a user which is asking why is the, or not actually not why, but like, are there any plans to make automatic dividend payout available also to lower tiers? So for people who are in a tier such as blue below 20,000.
Yeah, no, it's a good question. I mean, the reason why we didn't do it is because on a quarterly basis, the dividend which you will get is actually going to be very small. It's only going to be like $30, $40 or something, right? So the value is so low that the cost of processing it and actually transferring it did not make sense, right? So currently there are no plans to do this. And, to be honest, like, there is an amount of effort and resources that go in processing each of these trades. So it's only actually currently eligible for our black and, gold customers, right?
Great. There is one question which is relatively broad, and it's asking about the risk that is related to this investment. What would you answer to that?
I mean, see, all investments have inherently some level of risk, right? So at the end of the day, like, if you're investing in REITs somewhere, you are having exposure to the asset class. Now, the good thing, of course, is that, and this is again certified by the experts as SGX and the team, the advantage of a setup like this is that you're kind of diversified. You're not taking a single, like an Eagle Hospitality or one, a single particular REIT and take the risk of it, right? And that's why I personally like the SGD 20 index over some of the other broader indices, is that because we've gone for quality over purely dividend, which intuitively always makes sense. But, once an Eagle Hospitality kind of case happens, then it negates everything else that you've done, right? So for that extra, I don't know, 1%, you can end up losing 100%, right? Which never is a good trade, right? So there's a risk involved. Of course, if you choose REITs with risk management, the risk comes down significantly because it's a component of bonds. But of course, then you will obviously forego some part of your, yield and annual return, right? So for that matter.
Okay. There is a handful of questions left. One of them, Syfe offers a very unique proposition compared to other robo platforms. May I know how is Syfe positioned for the year ahead in lieu of the current investment climate?
So, I mean, could you repeat that question once more, sir?
Basically, how is Syfe positioned for the current investment climate?
Well, as a company, right? I mean, the sector we are in actually, I mean, and unfortunately, question from the time. Typically, when markets correct, sectors like us actually end up doing a bit of a reverse. So, in fact, for us as a company, I think the last 3 months have been the best 3 months since I've started, right? So, in fact, if anything, investors and board members and customers and so on look at it more favorably than you might think, right? So we're well positioned, and we're here to stay. If that's your question, and if that's your concern.
Great. There's 2 more questions about fees and charges. So question 1 is, are the fees fixed? My concern is that once my investment amount becomes large, I may be held hostage when the price increases. This is 1, and 2. Are there any double charges for REIT with risk management? One charge for the REIT component by Syfe and another charge for the bond component by an external party.
Yeah. Okay, so I think the first question, right? Like, yeah, the fees is fixed, right? I mean, traditionally, if you see, these fees like don't really change, and in fact, we also, if anything, can expect fees to go lower than higher, because as we start doing much more and higher volume, it becomes much more, reasonable for us to do at even a more competitive price, right? Bear in mind, there is no entry or exit charges, right? So if we ever change fees, right, you will end up withdrawing, right? And you'll withdraw all of it if that's not the right price. So you're not really held hostage from that perspective, right? So don't really think of it that way. So I hope you realize that, it's something which you should not have any concern about. The other question, right, was that, if is there another charge from the bond component? So for the bonds piece, we actually end up trading through an ETF, which is the NICO ETF, which is a great standard. But only for the bond component, you end up paying a fees, which is 25 basis points annually. So if typically, about 25% of your portfolio is the bonds, then about 6 basis points is additionally what you pay, which is actually a very, very low price for the quality of diversification and safety that they offer in bonds. But again, you're not paying a double fees. You can think of it for the first half year, it's essentially the REITs. The second half, where it's the bond that is getting exercised through the bond ETF, as the case might be. But it is actually negligible in the grander scheme of things.
Great. There is one more question about the management fee, which is, as this is the main source of revenue for Syfe, is this sufficient for future growth?
Yeah, you'll be surprised, right? The thing is that businesses like ours actually end up, scaling relatively quickly, right? We've built a setup which is very largely driven on technology. So our overheads are relatively low, which is what is the reason why we can offer such attractive prices, right? So the short answer is yes, we can, and more so with every passing day as our assets keep on increasing.
Great. Thank you. One more time, and I know we have answered this question already, but there is someone asking lump sum versus DCA for specifically for the 100% REIT portfolio.
Yeah, I think for any investment, if you don't need the funds, lump sum is better. 3 out of 4 times lump sum has shown to outperform DCA, right? But again, if you don't have the lump sum amount, or if your source of revenue is coming over time, if a salary and all, then DCA might be the right thing. I would not recommend people to borrow money and then do lump sum, is what I'm trying to say, right? See what works best for you, and it's a very case by case thing. But pure apples to apples, if I look at data, lump sum outperforms DCA. And this again goes to the thesis of, the time you have in the market is much more than timing the market. So keep that in mind.
Okay, and one more question. Okay, so it will be shown in the statement. There's 2 more questions left, which I'm having trouble to understand. Maybe they can send another question if we are misunderstanding. Any plan to reallocate of property types? So I think the question is, do we plan any to change the allocation among the different sectors of our REIT portion?
Yeah, I think Simon answered this earlier, right? They'll continuously keep on looking at on a regular basis, so that allocation will change as the markets reflect changes, whether it's decrease in hospitality or increase in residential, as the case might be, right? So that's why they have a dedicated team, a very expert team, which is looking at data and numbers on a daily, day in, day out basis, right? So that's something you keep in mind, yeah. So it will change, and as I said, as it changes, we will change to reflect those changes as well for you, which is the advantage of coming to setup as you don't have to copy it on a regular basis, or rather follow it on a regular basis.
Great. Today we have managed to answer all questions. There were a lot, I think almost 198 questions. Right. I think thank you very much for everyone's interest. Anything you would like to add to close today's session?
No, I mean, I couldn't thank Simon, earlier before he had to go, but it's been great that, he was a part of it and has been very instrumental in helping us and, build this out. Thanks all for, dialing in. Of course, I want to believe through our slides and through our Q&A, we've answered most of your questions. But if not, feel free to drop an email at support@Syfe, and the team and myself will be gladly here to, help. All right. Thank you, everyone. Take care and have a good evening.
Goodbye.